Welcome to the deep dive. Today we're doing something a bit different. A really surgical look at one of the most volatile corners of the market, diagnostics and research.
Yeah, we ran a custom stock screener just to see what's moving, and, well, the results were pretty explosive.
Exactly. We've honed in on the top 3 recent performers in the U.S. sector, and our mission today is to really unpack what's going on, to pull out the critical financial, technical, and, the news nuggets behind their big moves.
So we're diving deep into Exact Sciences, that's EXAS, Guardant Health, GH, and Natera, NTRA. And these are all, high-stakes, high-growth companies, really the future of personalized medicine.
From cancer screening to genomics.
Right. But before we get into the numbers, we really have to say this up front. We're looking at data snapshots, the figures, the scenarios we talk about. It's all based on reported movements.
And this sector is incredibly volatile.
Extremely. So this analysis should definitely not be taken as any kind of personalized investment advice. It's just an educational deep dive.
That's a crucial point. So our roadmap is simple. We're going to treat each stock like a mini investigative report. Start with the news, dig into the financials, look at the technicals.
And then the fun part.
And then the fun part, our paper money math challenge. We'll see what a hypothetical $5,000 investment would have done in just the past week. Okay, let's start with Exact Sciences. XAS, everyone knows them for Cologuard, their cancer screening test. Market cap is sitting at what? Just over $19 billion?
$19.07 billion, yeah. Oh. And when you look at the recent chart, it's just a vertical line. There's really one dominant story driving all of this.
It's the acquisition.
It's all acquisition. The whole story is that Abbott Laboratories is reportedly looking to acquire them for somewhere between 21 and $23 billion.
And that news just lit a fire under the stock.
A rocket, really. Yeah. The news of this potential buyout transformed it overnight.
So what was the immediate impact? We're talking a huge price move.
The velocity was just astounding. We saw a single-day jump of 16.81% just on the initial news.
Yeah.
And then the whole week, the rally pushed the stock up over 50%.
50% in a week?
Yeah. The market is pricing in that acquisition premium, and it's doing it right now.
Okay, but let's look under the hood. Acquisitions aside, what about the actual business? I mean, these growth diagnostics firms, they often run at a loss.
Oh, absolutely. They are definitely running at a loss. Their purported income is negative $986.58 million.
Wow. And the EPS is negative $5.32.
It is. And, that's pretty typical for companies that are just laser focused on R&D and grabbing market share. But the growth story is there. Sales quarter over quarter grew over 20%.
And here's what I found interesting. The gross margin is super strong, almost 70%. But then the operational margin just plummets to negative 3.92%. What's that tell you?
It tells you that Cologuard, the core product, is a cash machine. It's a phenomenal high-margin product. The issue isn't the product's profitability.
It's everything else.
It's everything else. It's the cost of capturing that next wave of diagnostics. All that gross profit gets eaten up immediately by, aggressive sales, marketing, R&D. It's the biotech playbook. Burn cash now for a huge payoff later.
And the market is clearly buying that story. A price-to-sales ratio of 6.19. I mean, are investors just betting on the acquisition at this point?
At this very moment, yes. That valuation is almost entirely supported by the news event. You're paying $6 for every $1 of sales, betting that either profitability is coming or, more likely, that this deal goes through at a premium.
So let's talk technicals, because this is where the chart really just screams. What happens when you get a 50% weekly move?
It screams extreme overbought conditions. I mean, the RSI, the 14-day relative strength index, is at an astronomical 91.03.
91?
Yeah. For context, anything over 70 is considered overbought. 91 is just. That's pure vertical momentum. It's a technical exhaustion point. The stock's at $100.67, way above its old 52-week high, and well past the average analyst's target price.
Okay, let's run the paper money challenge. If you, the listener, had put $5,000 into Exact Sciences exactly 1 week ago, before all this news broke, the share price was about $67.75.
Right. So based on that entry, your $5,000 would have picked up approximately 73.8 shares.
And after this insane week-long rally, at the current price of over $100, what's the bottom line?
With that 48.59% weekly return, your $5,000 investment would now be worth $7,429.75. That's a paper profit of $2,429.75.
In 7 days.
In 7 days. It's a perfect example of how M&A speculation can just generate these massive high-risk rewards in this sector.
Okay, so that's the M&A story. Let's pivot to Guardant Health, ticker GH. Here, the momentum seems to be built on something completely different. It's about clinical execution.
Yeah, totally different driver. Guardant is a leader in the liquid biopsy field with a market cap of almost $13 billion. Their focus is precision oncology.
Using blood tests to monitor cancer.
Exactly, and the driver is validation of their tests. The Shield CRC blood test is a big one. Recent news has shown really strong clinical data, like their Guardant Reveal test effectively monitoring chemo response. This isn't just theory, it's proof their tech works in the real world.
And I saw some incredible adoption numbers, too, which is what really matters for revenue.
Absolutely. There was data from a huge 20,000 patient study for their Shield tests that showed 95% adherence. That's massive.
Because it's a simple blood test, not an invasive procedure.
Right. When adoption is that high, it signals huge market potential. Plus, they're expanding access through big partnerships, like one with Quest Diagnostics.
Okay, financials. I'm guessing it's a similar story to EXAS, high growth, high burn.
You got it. Like EXAS, GH is operating at a loss. Income is negative $398 million. EPS is negative $3.21. But their revenue growth is even faster. Sales quarter over quarter grew an impressive 38.5%.
And with that kind of growth, I imagine the valuation is pretty stretched.
Oh, very. Their price-to-sales ratio is a high 14.38. That is pure optimism. Investors are paying almost $15 for every dollar of sales.
Betting that all this clinical momentum eventually turns into profit.
That's the bet. Their gross margin is strong, 63.76%, but the operating margin is deep in the red at negative 49.02%. So they're pouring even more money into R&D and scaling than EXAS is.
So let's look at the chart. Guardant has had a monster year.
A remarkable chart. Performance year to date is 228%. Performance for the full year is 246%. The price right now, $100.30, is just knocking on the door of its 52-week high.
What's the short-term momentum look like? Is it as overheated as Exact Sciences?
The RSI is elevated for sure. It's at 73.82. So that's still technically in the overbought zone, but it's much healthier, much less volatile than what we saw with EXAS.
And the key takeaway?
The key takeaway is technical strength. The price is trading way above all its major moving averages. It's sitting a massive 85% above its 200-day average.
Okay, paper money time for Guardant. Based on its weekly performance of 6.55%, if you invested that hypothetical $5,000 1 week ago, your entry price would have been about $94.13.
Yep, and that would have gotten you 53.12 shares of Guardant Health.
So with the shares now at $100.30.
That would translate to a solid paper profit of $328.84 for the week. It's a far cry from the M&A lottery ticket, but it's a very strong return based on real sustained progress.
All right, finally, let's turn to Natera, NTRA. And this one is surprisingly the biggest of the three. Market cap over $31 billion. They're focused on genomic testing. What's their story?
Natera is a diagnostics behemoth. They got their start with non-invasive prenatal testing, or NIPT. Their Panorama product is really well known.
But the excitement now is more in oncology.
Completely. The momentum is now all centered on their oncology platform, Signatera, which focuses on something called MRD.
Measurable residual disease. Let's unpack that really quickly.
So MRD is all about detecting tiny amounts of cancer DNA that might be left in the body after treatment. Signatera is used to monitor for cancer recurrence way earlier than traditional imaging can.
A huge deal for patients.
A game changer. And the news drivers are all about clinical acceptance. They presented great data at ESMO, which is a major European cancer conference, and they just integrated with Flatiron Health's platform, which is a key IT system for clinics.
And the long-term growth rates here are just exceptional.
They're explosive. Sales over the past 5 years averaged over 41% growth annually. And analysts are forecasting that EPS to grow at an eye-watering 57% for the next 5 years.
And I guess that explains the valuation. A PS ratio of 14.71, PB of almost 25.
Yeah.
I mean, how do you even justify that for a company that's losing money?
That valuation is pure extreme confidence that Natera will eventually dominate the genomic monitoring space. It's a bet on future market share. The one bright spot financially is their balance sheet. They have pretty low debt, a debt to equity of just 0.16.
Let's move to the technicals. The multi-year performance is staggering, up 560% over 3 years.
The strength is just undeniable. The stock price, $225.55, just broke past its 52-week high. And its beta, which measures volatility, is the highest of the group at 1.59.
So it moves almost 60% more than the S&P 500.
Yeah. Investing here is not for the faint of heart. The swings are huge.
And the short-term momentum, overbought again.
Highly elevated, yeah. The RSI is at 77.26, so again, confirming that overbought status. But the price is really well supported, trading almost 40% above its 200-day average, so that long-term trend is just powerfully upward.
Okay, final paper money challenge. Natera had a strong week, up 12.48%. If you invested $5,000 a week ago, your entry price would have been around $200.67 a share.
Right, so that would gotten you about 24.92 shares.
And with the price now soaring to $225.55, your estimated paper profit for the week
Would be $619.26. That 12.42% return really reflects that high beta, high momentum environment that Natera lives in. Hashtag tag outro.
So we've looked at three really dynamic companies, and a pretty striking pattern has emerged. Exact Sciences, Guardant, Natera, all non-profitable, but all showing massive sales growth.
Yeah, and it really paints a clear picture of the whole diagnostics and research sector. You see these consistently high price-to-sales ratios, which tells you investors are paying for the potential of future revenue, not today's earnings.
And that's coupled with extreme volatility, the high betas, those crazy RSI numbers.
It's a sector defined by aggressive optimism.
And it's not just retail speculation. The institutional ownership across all three is exceptionally high, right? Between 94 and 96%.
Exactly. This means the really big money, the massive funds, they strongly believe in these long-term clinical stories. They're staking billions on the future of genomics and liquid biopsy.
Which creates this constant tension. And I think that's the big takeaway here.
Yeah, the question isn't just are they growing, it's is the price justified?
Precisely. Yeah. And that's the final thought we want to leave you with. Given that two of these companies, EXAS and NTRA, reported really strong Q3 earnings before these massive price spikes, the question to mull over is this.
How much of this is real?
Right. How much of this current technical exuberance, the high RSIs, the PS ratios near 15, is driven by fundamentals that are actually getting stronger versus just pure market enthusiasm and short-term news like acquisition rumors?
Are investors getting it right, or is the excitement about revolutionizing cancer care maybe inflating these already premium valuations?
Understanding that dynamic, that interplay between the science, the market psychology, and the financials is really the key to tracking this entire space.
It really is.
That's a deep dive with plenty of homework. We'll catch you next time.